You're listening to the Build to Rent podcast. Build to Rent podcast.
Welcome to the Build to Rent show. Steve Olson here with Chase Levitt and Sherida Zanger, queued up for another episode on what we feel like is going to be one of the main topics. Many of the headwinds in the business right now are all resolved if this particular situation, I don't want to say settles down or just figures itself out, which these things have a tendency to do. We don't know where it'll figure itself out, but it eventually will. And that is rents. I've got an article here from Apartment List. This was published on January 4th, and it is about the National Apartment Rent Report. They collect all this data from everybody, what has happened everywhere. A lot of times they're talking nationally in many of these figures, and I think it's really important to drill down locally, right? Here we're sitting in Utah right now, we don't really care that much about Manhattan rents, right? So this is the report of 2023. The national index for rent fell by 0.8% over the course of December 2022, marking the fourth straight month-over-month decline. The timing of this cool down in the rental market is consistent with the typical seasonal trend, but its magnitude has been notably sharper than what we've seen in the past. This suggests that the recent swing to falling rents is reflective of a broader shift in market conditions beyond seasonality alone. As we look ahead to the new year, we expect that 2023 will see bargaining power shift back to renters, and that rent prices this year will only grow modestly, if at all. Okay.
Sounds kind of bleak for the investor.
If you were assuming 10 to 20% rent growth in a build for rent financial model, you are quite screwed with that data.
Yeah, and I think that's why it's not good to assume or project what it's going to be, right? So take where rents are, and that's what we do. We take our rents where our current rents are at and put it in our pro forma. And then we like to soften that just a little bit, be conservative. And that's what's really, I think, helped us.
Yeah.
That's what we did on our other projects.
Yeah.
And like Entrada Farms, for example.
Or Laguna. We were really conservative. And then things jumped up, like we're seeing in this chart here. 2021, rent growth was at least 1 to 2 to 3% every month. And so we're projecting the 1,400 went up to 1,900 per unit. That's a 3-bedroom, 2.5-bath townhome. And then, last year was when we saw it soften. Mm-hmm. And why did it soften? Probably because of inventory, competition, and then things changed a little bit, right?
Yeah. And I've been telling people that tenants were able to, in a way, ignore the rapid inflation increase in rents because it hadn't yet clobbered them everywhere else. But 2022 was the year where, okay, now my groceries, I definitely know they're way more expensive. My gas, everything, something's got to give.
Yeah, like all the memes you see about eggs, right?
Yeah.
I didn't know that eggs were costing as much as they were now, right?
Mm-hmm.
And so you're right. I think it's hitting them in every direction. Fuel.
Yeah. I used to joke, it's not like they can live under a bridge. Well, I'm like, some of them chose to.
Yeah.
That was their best choice, right? The article, if you don't mind, it says that the cool down in rent growth is being mirrored by continued easing on the supply side of the market. Our vacancy index now stands at 5.9% after more than a year of gradual increases from a low of 4.1 last fall. And in the past 4 months, which were critical months, by the way, this easing of the vacancy rate has picked up steam again after plateauing a bit over the course of last summer. Today's vacancy rate still remains slightly below the pre-pandemic norm, but it's quickly approaching that benchmark. It's just, you got to wonder, are we just going to go back to pre-COVID? Was that so insane and out of its mind that we're just going to kind of revert back to it in a whole bunch of ways?
Maybe. It just got so insane after COVID. Prices and rents just started going up drastically. So I think that's a big part of why we're starting to see things soften price-wise and rent-wise.
Yeah. How will that kind of depeg? Because it was so hard to see through the noise of, okay, rents are definitely backing off. And they're not plummeting, right? You're just not getting those giant increases that you used to be able to get. They're not plummeting. But how do you untangle the seasonality from the increased supply and just the general uneasiness? Now we get that. We're in January 2023. Seasonality is going to begin to fade, right, as we get into the spring especially. So what's really happening? It'll be, because I was playing around with a financial model yesterday. And when you're going to syndicate like a whole build for rent project, you have all these variables that are in your financial model that really affect the internal rate of return. And of course, your net operating income is great. We have to have that. But there's two things that, in my mind, if you are relying on these things to make the deal happen, you probably shouldn't do the deal. Rent increases faster than the rate of inflation, and a cap rate at sale or a terminal cap rate lower than where you went in, because you're assuming everything's going to go your way. And as soon as it doesn't, as soon as it goes even about the same, I mean, that IRR is impacted massively. You say, I'm buying this at a 5 cap and I'm selling at a 4.5. The IRR goes bananas, right?
And the new price that you can sell it at. So you get all excited about that.
That's because that's what it's tied to, is that new price, right? And that really impacts it. Like if you can get away with modeling it at the same or a higher cap rate and normal rent increases, that's a sweet deal. That's going to more than likely work really, because you're not assuming everything's going to go your way. So we talked a couple months ago on a deal that we felt like was really good, but it just wouldn't work. Stupid deal, wasn't cooperating, even though it was awesome. And I was arguing to you guys that, well, these things aren't going to deliver for another 18 months. We think rent is $2,000. Rent's going to be $2,100, $2,200 in 18 months from now, right? And I felt really, really good about that. That was a very reasonable argument at the time. I'm not sure I'd do it now.
Yeah.
Because it just assuming growth, even moderate growth, according to Apartment List, they're saying, we're probably going to just kind of plateau at some point this year. We've given back some of that COVID, and now we got to grind through the supply and recover a little bit. What do you think?
No, I agree with you. It'll be interesting to see what happens as we turn over for Utah and Idaho, seasonality, like you talked about, to see what happens when rents, or I should say lease up should start happening, or renters looking to move a little bit from April to September. Arizona, I think, is a hot time right now for renters to be moving around.
And I feel like they're still renting stuff in Arizona, but like this says, the tenant's going to be the one that has a little more leverage. They can be picky and kind of maybe demand a little bit more. I don't know, go in and negotiate a little bit on rents.
We have a very B-class product that is going through stabilization in the Northwest Valley of Phoenix. And if I recall, when we originally pro-formed that thing, we felt like rents would be like $1,250 or $1,300 a door. This is a 2-bed, 2-bath, 1,050 square foot unit, no garage, and some light amenities like a basic clubhouse and pool. And these things started coming online, and before we knew it, one of the floors was getting what, 17?
I don't know, was that higher? I thought it was like $1,595. It was higher than what we had projected.
Well, then they added on
the tech fees.
Yeah, they're like,
originally we weren't going to add that on.
Exactly.
Okay.
Tech fees is just it's like the airline charges you a bag fee. It's not optional if you want to bring your bag, and you're just going to pay it. And so they were able to monetize that. And so I think after the tech, high 16s, some of them. But the norm was definitely the low to mid 15s, if I recall. Mm-hmm. And that, I mean, the getting was good, right? Late, when was this? Early 22?
Yeah.
Yeah. Mm-hmm. Yeah. And that was just in time for his interest rates started to go up. But then, wow, they really went up, and those rents, they backed off. Now, they're still higher. I think they're really close to pro forma. I think they're at pro forma, or if you add the fee, I think we're 14-ish a door in most cases. So it's like you get those COVID gains, you give some of them back, you're higher than you thought. But I think that's because in that submarket, that's what people can afford.
Yeah.
Right. I mean, it's been interesting to see it do that. So is it going to edge down? Is it going to stop? I don't know.
I think the only thing that messed us up on that, and again, it was nothing to our fault, was maybe the interest rate was probably lower than what we had. It's higher than what we had projected, so it was lower on our pro forma.
Yeah. Well, that interest rates.
Kick to the teeth.
I mean, that's why it's good to be conservative, like we've talked about, because timing's everything, and you can't time it all the time.
Yeah.
Talking about one project, Village on Greenway, right?
Yeah.
In Arizona. And it's funny how if you got in early, that it helped them out. Where the rents were higher and they locked in a lower interest rate. But then you had the middle and the back half of that project. It's been a little bit slower and some of those units aren't finished. Rates shot up, rent softened a little bit. So, and it's still a huge win for those investors as well because of how we penciled the numbers in the pro forma. So it's good to be conservative and understand that. But timing's everything. Things can change in 3, 6, 12 months as we've seen.
Mm-hmm. Mm-hmm.
But when we're also probably going to see some of those investors that had the higher rents on renewal or on a move out and a new tenant.
Change, yeah.
Seeing that change.
Yeah.
So they're going to have to be okay with that, knowing, hey, you got in when the getting was good, and now, you know, it's back down a little bit. So some of the people that are completing right now, more realistic numbers.
It's a long-term game, and you have to have a thick skin. You know, it's how do you balance that? I've always struggled with it. There's not a right answer, but you know, how do you be aggressive when it's time to be aggressive? How do you use caution when it's time to be cautious? Because you know, you can be too cautious, and you talk yourself out of every single deal, while perfectly good ones float right past you. And then you can do that one deal that you never should have done. It's a hard. That's why I think. There's that old saying, if it was easy, everybody would do it.
Yeah.
Because not everybody wants to do that. And hey, treasury bills are like 4% right now. I remember in a finance class I took, they were talking about the discount rates. You know, what's the risk-free rate of return that you can earn? And you know, the investment you're considering as an alternative needs to beat that. And there's all these finance figures, net present value, stuff like that. And I always thought it was stupid because I mostly came into real estate in the low interest rate era. I'm like, what are you talking about? Risk-free return? There is none. T-bills don't pay any money, right? There is no risk-free return. You're losing money going into that. And now I'm like, oh, okay, I get it. With all this inflation, you could take your $1 million, 4%, no risk whatsoever, or, you know, a 6% return, but a bunch of risk. I mean, I know some people that have just gone into treasuries right now because I'm wait till this is over. This is dumb.
Yeah.
Yeah. I don't have to worry about, is my tenant going to renew at a lower rate? If it was easy, everybody would do it.
I think this is one of those topics that we need to revisit come spring.
Oh, yeah.
Probably like mid to end of spring, and then again mid to end of summer, just to kind of see, hey, where are we at? What do things look like right now? Be interesting.
Yeah.
And leading into that, because I agree with you, is this little chart here. So apartment list national vacancy index from 2019 to present, just so our listeners know. 2020, the vacancy rate there I'm looking at, so this is post-COVID, right, is 7.2%. 2021, towards the end of the year, it was 4.1%, so dropped about 3% on vacancy. 2022, towards the end of the year, December, it went back up to 5.9, so up 2% from 2021, but still not where it was in 2020. So just remember that 5.9% is where on the apartment list of national vacancy index. Let's follow up on vacancy. We'll get into rents a little bit more in the next couple months and see where they go.
Mm-hmm. Yeah, let's watch it. You know, it's funny this is localized to a degree. I own real estate in Indianapolis, and I've not given anything back. They've actually gone for some aggressive increases that they had to pull back on a little, but I've been fine. So it's interesting to see. There's a lot of markets in the U.S., and granted, and something like inflation does affect all of them, but not to the same degree.
Well, I'm tagging this article so we can revisit the article,
Okay.
and then I'm going to put it on my calendar to come back and revisit this, sometime end of April or something like that.
It's on the calendar.
Got it.
It shall be done. Well, we've got to get on a call about some new projects that I hope we'll be able to talk to you about. Yes, we're crazy. Letters of intent are going out. We're walking that line, rolling that dice between there's some stuff that we don't like that's happening right now, but willing to take some risk on putting some dirt under contract, getting the engineer started, knowing that this really gets serious in about a year from now. So we're taking the chance.
There's the alarm.
There's the alarm. We can't keep going now. The alarm went off. Thanks, everybody. Please subscribe on Spotify, iTunes, or wherever you get your podcasts. You can go to b2rshow.com. It's .com, isn't it?
Sure.
Sure. Try .org, .gov,
.us, I don't know.
But probably .com is where I'd start if I were you. And you can send in questions or comments on deals or things that you'd like to talk to us. You can even send in hate mail for Chase. We'll catch you next episode. Thanks.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.